So what other strategies can you do besides the lease option? And the strategy that I want to recommend for you that's close to a lease option is one that's called a subject to. Essentially, what a subject to strategy is a strategy that is very similar to a lease option in the sense that you're taking over somebody's payment. The difference is, in a subject to, you're taking over somebody's mortgage subject to their existing loan. So, you own the property because you have the deed to the property, yet you're not getting new financing. So that loan stays in place. So you're taking over their mortgage payments. So that is different from a lease option because now it's no longer a lease. You have ownership in the property. And we usually do a subject to transaction when there's money at risk because let's just say if the seller was actually in default, maybe a couple months, we would catch that mortgage payment and bring it current. And so we would have to put money at risk. And anytime you have money at risk, you want more security than you would with a lease. So let's say they need money to move. Let's say they need money to fix up the house. It needs about $10,000 worth of work to really be able to rent the property or sell it. So anytime money is at risk, usually more than 2 months of mortgage payments or 2 months worth of rent, then you ought to switch up to talking about subject to strategies because you don't want to lease a property, put down a lot of money to fix it, put down a lot of money to bring the loan current, and maybe you're at risk $10,000, $20,000. That $10,000, $20,000, well, you can go buy a house and even have a brand new house that you own and you put money down towards a loan. So when you have money at risk, switch the language up to a subject to strategy. And be aware of that because you don't want to be talking about putting down a lot of money and still be leasing the property. So subject twos are very similar to a lease option in that regard because there's money at risk. The other strategy that works these days in this marketplace is what is called a short sale. And a short sale strategy is essentially when the bank takes less than what is owed. So let's say the property is worth $200,000 and what is owed may be even $210,000. The property is upside down. So you would negotiate with the bank to accept maybe $130,000 or $140,000. So you're asking yourself, wait a minute, why in the world would the bank accept so much less than what is owed? Well, the bank has a certain quota to meet. They can't have their whole portfolio be in the red and be non-performing assets. So they're willing to entertain short sales if presented correctly so that it makes good business sense to accept and unload these bad debts. So for example, every bank out there, for every $100,000 that they have in bad debts, they have to have 7 to 10 times that amount of money in reserves. So if they have $100,000 in bad debt, they have to have $700,000 to $1 million in reserves to back up that one bad debt. So what does that mean? That means they can't lend out $700,000 to $1 million because of that one bad debt. So short sales are very good strategies in this marketplace because for banks, it's helping them. It's helping them with their portfolios. They also have to do this. Actually, some homeowners who are in default, they send out letters with short sales as an option. And for the homeowner, it's good because foreclosure on their records is basically one of the worst things that can happen. So by getting the bank to accept the short sale, that relieves them of that really bad debt that they have on their credit that can haunt them forever, that would make it tough for them to purchase for the next 5 or 10 years. So short sales are a really good strategy in this marketplace because you'll be helping the bank, you'll be helping the homeowner, you'll be helping the buyer get a good deal, and of course you'll be helping yourself as the investor. So lease options, subject tos, short sales, those are really good strategies right now in this marketplace. And you need to look at traditional ways of selling it as an old way because it's not working because there's so much in bad debts out there, there's so much in inventory that's available that you have to look at alternatives.